Hello and welcome back to another episode of Outsourced Alpha. We are in the dog days of summer and we have very interesting topics to discuss today when it comes to the LP perspective and capital formation and how that comes into form across placement agencies. So before we get into it, I'd like to set a theme to anchor everything else across this conversation. So our friends at Rede Partners run a liquidity index twice a year. We'll refer to it as the RLI, which basically, as I understand it, asks several hundred institutional investors whether they're putting more money, less, or the same into private equity over the next 12 months. So consider anything above 50 to be expansion. More money's coming in, below is pulling back. And this is the 17th edition. And if I were to indulge in my dorkery, I was able to read through it a few times before this conversation. So a few of the headline numbers, just to set the stage, 59, which is up 2 points, 34% plan to deploy more, 50% hold steady, 60% pull back. So there is cautious optimism, and it's still very well below the pre-2022 levels. So you have a good news, bad news divergence here in that we have pretty good deal volume, the highest in 3 years is 660 billion. You have buyouts that are over half a billion, running 20% ahead of the 2021 peak. And then you have valuations, which depending on the asset class or the segment, you could get mixed reviews, but they generally rose 3.9%. And that's the strongest uplift since the pandemic and COVID. The bad news, and we can get into some of this too, because Alex is a master in her own right, fundraising fell for the third straight year. So when you consider net capital, negative outflows, when you have average close time hitting an all-time high of 25 months for a fund, and then you have on the deal side this backlog of unsold companies that grow from 13,000 to 16,000 with a median hold period around 7 years. So there's a lot to be said about this concept of zombie funds, how those are compounding. LPs are still paying fees. So deals are happening. Capital formation perhaps hasn't caught up quite yet. And there's a lot more we can talk about, but I'm not the expert here, which is why we're fortunate enough to have Alex Bazarewski from Rede Partners on the line. And so, Alex, welcome to the show. As we do with every episode, we'd love for you to introduce yourself, your background, importantly, and how you got to your role today at Rede Partners, which I understand has evolved recently, and I wanted to extend some congratulations as well.
Well, Derek, thank you so much for having me on today. It's a real pleasure. I've been following what you do here, and it's always great to hear your podcasts. So to introduce myself, I'm Alex Bazarewski. I'm one of the managing partners at Rede Partners. As many of you may be aware, Rede is the leading independent fundraising advisor to the private markets. The firm was started back in 2011. So we actually just celebrated our 15-year anniversary. And, I think there's a few things that really make us distinct from sort of other players in the space. The first is that we are a primary first focused advisor. So we think there is a real art to primary fundraising that is sort of separate and away from transactions and CVs. And so we've really built our entire business around the art of primary fundraisers. The second piece that I would note is that from the beginning, we've always thought of ourselves as a true advisor to the GPs that we work with. And we work very hard to build sort of the trust to be their thought partner as they think about the growth and the evolution of their business. Sort of in whatever fashion that is, we really try to help our GPs think about what are near-term goals, what are long-term goals, and what's the right capital formation strategy to enable that. I would say the other piece that is very core to what we do with our GP partners is really help them think about the story that they are telling and how we pull out those spikes of differentiation in sort of an increasingly competitive market. And how do we ensure that we turn every single interaction with LPs or others in the market into sort of a brand enhancing one. The final piece that I'll call out is our independence and the alignment that comes with that independence. We always say we don't have any sort of big balance sheet to rely on. We only our business only works if we deliver for our clients. And we think that is just a really fantastic sort of alignment and enforcing mechanism to deliver. So that's a bit about Rede. Maybe the only other thing I'd say is that we do run a focused high conviction model. We do a lot of work on the GPs that we partner with up front, build that conviction because we think it pays just massive dividends when you're out there and you can really sort of look into the whites of LP's eyes and really pound the table as to why we got conviction, why in fact actually we were able to invest in, we invest in the funds that we raise. So it's very powerful to be able to say to an LP, like, I picked up a pen to write a check here, and this is exactly the reason why. And this is exactly how I got over that issue. So yeah, so that's a little bit about Rede Partners. So I joined Rede about 10 years ago to open our North American presence. Prior to my joining, we were just one office in London, working exclusively with European GPs. So the idea when I joined was really to first actually deepen we'd always raised money from North America. In fact, the first ticket Rede ever raised was from a North American LP. But the idea with opening a presence in North America was really first to deepen our presence with North American LPs. And then over time, really bring sort of that great value proposition we brought to European GPs to the American market. And so here we are 10 years on. We actually have two offices now in North America, one in LA, one in New York, and we're about 40 people here in North America. And we are incredibly proud of all of the great partners, GP partners that we've developed over that time, many of whom we've now actually done several raises for. And actually the other point is sort of since that time, Rede as a business has continued to sort of grow and thrive. At this point, we've closed over 110 primary fundraisers. We've raised over 150 billion of capital for our clients, about 37% of which is sort of pure new capital. And today we're a genuinely global firm. So we have 6 offices across the globe. We're covering institutional LPs in 63 different countries. So it's been just a fantastic journey.
So you've seen a lot of success in growing from the European presence to the US. I imagine that there are behavioral differences between the European LPs and the US LPs. Before we get into anything, what are some of the biggest observations that you guys have had and what you have learned in expanding from the UK and Europe over to the US?
Yeah, it's a great question. And I think there have been many examples of firms trying to go across an ocean or into other countries and really finding that challenging. And so we are super proud of how we've been able to do that so effectively. And I guess, the learnings from it, I think are a few. I think one of the things that Rede really invested in order to make this right is making sure that everybody felt a part of the same team. So whether that's investing in ensuring there's enough in-person time together or ensuring that, sort of incentives, everything is completely aligned. All of that is incredibly important. I think the other piece, with any sort of growth avenue or, development within a company, I think really having leadership's backing and support goes a tremendously long way in terms of just back to that. We're one team, we're in this together, we're going to deliver this together. So no one feels like they're out on an island. I think there are probably 2 or 3 other things that I'd mentioned that I think really set Rede up for success on this front. One is actually when I started, I had the great fortune of living in London for call it 6 months or so, where I was just really getting, fully steeped in the Rede way, really building those collegial relationships. The other piece is that actually Scott Church, who's one of the founders of Rede, he is American sort of by background, but at the time of when we set up the Rede American office, he'd been living in London for like 25 years. And so him coming back to the US certainly also really helped ensure there was the right connectivity. And then maybe just the final thing I'd say, and I think it's a great for a number of reasons, but we've always had a sort of very positive approach to people moving across offices. And so I think that's great because it creates flexibility, mobility, opportunity for various members of the team to work and live in other countries. But it also just really reinforces this cultural glue that is so important.
Awesome. Yeah, it can be challenging to manage cultures across markets, but you guys have done a great job. I'd like to go into the RLI because I think it tells us a pretty big story in 2026. And as I understand it, you're interviewing and surveying LPs on their appetite. And given you are a replacement agent as well, you're also getting the perspective of GPs during a fundraise. So maybe thematically, we can start with where are you seeing the most divergence between what an LP is looking for and what GPs are telling you is working or not working in the market?
Yeah, I mean, it continues to be an interesting market, is maybe what I would say. We obviously sort of all remember sort of the lockdown days of COVID, where programs were going on pause. We thought we would maybe never raise another dollar, and then you sort of went right into the heady days of 2021, where like funds couldn't get raised fast enough. And then I would call sort of the more recent period a little bit more, certainly more muted than that period after COVID, where all eyes have been on DPI, valuations, et cetera. As you mentioned, we do this RLI survey twice a year, where we survey, hundreds of LPs across the globe to really assess the availability of capital for investing in private equity over the next 12 months. And so I always think of it a bit like the purchasing managers index. If the score is above 50, people are buying more. If it's at 50, it's the same. If it's below, people are buying less. What was encouraging in the most recent report, that the number came in at 59. So obviously that is a positive indication. And actually, within that number, I believe it was 38% of LPs were actually saying they were increasing their exposure to private equity, which is a number we haven't seen since 2021. So that was very encouraging. I think I always sort of explain it as follows. I think there is a lot of belief and appetite for the asset class. People want to put money to work here, and the but is real, like private equity allocators need to justify why they are locking up capital for 10 plus years and really justify that the premium is there. And that's gotten harder, as we've all seen the public markets sort of continue to defy gravity. But I think the willingness is there. I think when you sort of dig into where is appetite, what do people want? Actually, the sub indicators show that there is slightly more interest in new relationships and new managers and smaller managers. And so, that is something that, any GP really needs to pay attention to. You can't take your existing LPs for granted. You really have to work and build those relationships, make sure that that conviction is as strong as ever. I would say maybe just one other thing, we certainly, it was cited in the news last year. We live in a world now where there are more private equity funds than McDonald's and the like. So, LPs really are spoiled for choice. They've got a lot of options. And so GPs are going through more and more intense diligence to get that re-up or fresh commitment. In particular, I would say at this moment in time, the areas that LPs are super focused on are of course, no surprise, DPI exits. And then the other piece that we've certainly, maybe the other two pieces that we've certainly seen more focus on is unrealized valuations, and do those really hold water? And then team and alignment, really making sure that economics, incentives, et cetera, are really make sense for the long run.
Yeah, on the economic side, it's super interesting because you look at this rise of co-investment demand, and in my novice understanding, the economics in a co-investment are way more favorable for the LP, and the GPs need to keep the lights on. So, how are those conversations managed between the GP and the LP when it comes to a rise in demand for co-investment, but the requirement for a GP to actually assess fair economics for their fund? In your mind?
Yeah, it's a good question. I mean, look, I think co-investment has certainly gone through an evolution. It is a lot more frequent to see co-investment available today than it was, call it 5, 8 years ago. And, perhaps because of that and I think that phenomenon is true for a number of reasons, including LPs have now sort of armed their teams with the right capability to not only underwrite those opportunities, but to do them in a timely enough manner that, they can make deadlines and everything else. I think as far as sort of like how do you think about the economics, there's a small proportion of those co-investments, certain GPs that do charge economics on co-invest. And so that is, of course, a little bit more straightforward. And that's done either through co-invest overage vehicles or, sort of on the individual co-invest themselves. When that's happening, it's typically a pretty high caliber GP that sort of has the right to do that. And as I said, it is really sort of a smaller portion. The the vast majority of co-invest is fee free for existing LP partners. And, I think the way that sort of contract works is you are a full fee paying existing LP, so you're paying through the fund, and the co-invest is a bit of a sweetener on top.
Yeah, no, it's been around for a while, and I think the dynamics have changed to your point. And then the SPV strategy, the syndication deal by deal, has also risen. Just to pivot a little bit, because something more broadly, when we talk about investors being in a liquidity crunch, it's no secret that there have been a lack of exits and that people have called valuations into question across different segments of private equity. But then, I mean, something encouraging is sort of an uptick in allocation into a new manager. So I guess the question that I have for you is, does that mean that they're firing one to hire another, or is this net new capital, in your opinion, into private equity as an asset class? How do you read those numbers?
I would say for the most part, it is a rotation, right? So it is, unfortunately, usually a new commitment at the expense of an older commitment. And, you are usually seeing LPs rotate. Sometimes it's between funds of a similar size, but actually a lot of the time it is sort of culling a manager that's gotten much larger and going back down market. The idea being that when LPs start a new relationship, they don't want to do just one fund. If they're going to do all of that work and build a partnership, they want to invest in at least sort of 3 funds. And so obviously, the way the math works is if you start sort of lower in the market, there's more runway for that relationship. I think, it is for new managers, I think it is a particularly interesting time. It used to be that if you spun out of a large GP, you would just, if you had the goods, if you will, you would just go raise a blind pool fund. Today, that's quite different. There's a lot more options sort of on the table. There's the deal by deal phenomenon, which is a great way to sort of prove out your standalone track record. There's a number of LPs that are very supportive of pledge fund structures where you're sort of tacitly allocating and interested, but you still can look at each deal and decide whether you want to do it. And then of course there's still the blind pool available as an option. But what I'd say is sort of developed on that front that's quite interesting is there's now a number of players that really sort of seed and back those blind pools sort of by design, whether it's, someone like Grosvenor or Wafra or TPG Next, and then there's the other dynamic of, and this is true not just for new funds, but in general, as funds are getting raised, GPs are doing deals. And so actually you can see by the time an LP invests, sort of by design, there's a look through. You can see some of the assets that ultimately you'll be buying, which really does help alleviate some of the underwriting burden.
Yeah, the underwriting burden has not gotten any less strict as far as, I don't know, LP due diligence, you're talking about hundreds of questions in an RFP, which, technology can solve to some degree. But that burden is placed on the shoulders of the GP, and many times they don't get that allocation. So, what are some of the tips and tricks and shortcuts, if you were to have any, that a GP could take into consideration when an LP approaches them? They say, I'm considering investing into your fund. You're a first time manager. This is the first time I've actually allocated into your fund. How should they approach that conversation so that they understand when somebody is just, more or less price shopping versus when somebody is seriously considering an allocation in your mind?
Yeah. No, it is it's tempting to think that everyone is real and everyone has lots of money that they're about to invest imminently. It's not always, certainly not always the case. And so I think obviously, and I would say this, but when you work with an agent that really knows the market, that has seen LPs transact or not transact over and over and over again, that is probably like the easiest and best shortcut because they know exactly who's real and who's not if they're good. But I would say beyond that, if you're not working with an agent, I think, I think it is important for GPs to ask questions, to ask the right questions, to understand what do processes look like. Do you have budget? Understand who are the decision makers and how approval decisions or denial decisions are made. But I think, I think, look, there is sort of the like tech aspect, like you can harness AI and technology to complete the RFP, but very rarely are investment decisions made on like an RFP alone. The human element really matters because at the end of the day, this is a relationship business, and I often say like blind pool funds are one of the last sort of like trust me assets out there. And so you really have to believe in the person that you're investing in, believe in the team that you're investing in. And so, diligence is often, there's a lot of in-person time that is required to get LPs over the finish line. And I think what GPs can do during that in-person time is really make sure they're asking the right questions to really understanding, as I said, exactly how decisions are made and how realistic a commitment is and therefore assess are they spending time well or not.
Yeah, it's super interesting. And I'd like to go into different segments of the market and different product types because you have an expert opinion on this. For example, in the RLI, one of the most interesting numbers that I saw is that tech focused funds fell 17 points to 8%. This is the lowest that has been recorded in the RLI ever. And I mean, I imagine that has something to do with the AI arms race, which might be perceived as a risk, not an opportunity, but you can tell me differently. So do you see any strategies within private equity that are thriving? And on the other hand, are LPs looking at product types like evergreen funds and anything else that is creatively getting spun up on the market as an opportunity, or do they see them more neutrally when they're underwriting a new fund?
Yeah. So I guess, look, first I'd say like LPs are, a very wide spectrum. And so, it really depends sort of the type and geography, et cetera. But what I would say is what the data says in the RLI is, yes, as you noted, tech, which has consistently dominated the sector rankings, I think since the dawn of the RLI has come down quite a bit. A lot of that is a function of, the survey was done in the midst of the SaaS apocalypse, if you will. You know, there, just as sort of AI disruptions really sort of spooked the public markets first and then the private markets. I think what's sort of like hidden in that number is, this is where you're putting money to work in the next 12 months. What's hidden in that number is that LPs already have a tremendous amount of tech exposure sort of in the ground. And so, it's been one of the most robust parts of the portfolio. So I think what it reflects is more of a like tapping the brakes, assessing the situation, figuring out what are the right top types of software, which managers are sort of navigating this AI evolution the best. And certainly that's what we hear anecdotally from LPs too. I don't think anyone's wholesale out forever. It just let's sort of tap the brakes and see where sort of the puck is going on this front. In terms of sectors that we're seeing sort of maybe an uptick, I mean, the one that I would say in particular we've seen an uptick in the past few years has been aerospace and defense. And this has been true in America, I'd say for a while, but I think in the past year or so, you are now also seeing this phenomenon develop in Europe as well, given some of the changing geopolitics, et cetera. So yeah, and then and then I would say, look, I think industrials, business services, healthcare, these are sort of stalwarts of LP portfolios, and so it's not to say if you're an industrial manager, you're definitely going to get funded. It's that it is if you are an industrial manager that has a unique way of generating alpha, unique way of sort of capturing carve outs, whatever it is, that is an area that most LPs have exposure to. I'd contrast that to there are some other, parts of the economy that maybe are a bit more, to use a British term, marmites. Some people love it, some people hate it. Things like, consumer, oil and gas, at times financial services. So it's just a matter of, really knowing the LPs, knowing what they want and care about, and making sure you're spending time wisely in terms of who you are allocating hours to.
Got it. So if we fast forward a year, where are we at on the RLI? Are we going up and to the right, or do you think we're regressing a little bit?
Good call. I wish I knew. I mean, look, well, I'm an optimist in life, and I believe deeply in private equity as an asset class. So I think I by default have to say it is at least at 59, if not getting better.
There you go. You heard it here first. I'd like to shift gears because, we at Juniper Square are intimately involved in the IR process. We have a CRM, we have data rooms, we have digital subscription tools. LP experience is the cornerstone of much of what we do. Even recently, DDQ automation, right? So there's a lot going on there. And you have spoken quite a bit recently on the advent of AI when it comes to IR. And we don't necessarily have to bridge those two things. This is not a product pitch for Juniper Square, but I'd love to get your perspective on what you've been talking about recently, since we had a conversation about this not long ago, and some of the interesting observations that folks should be on the lookout for heading into the back half of the year.
Yeah, no, absolutely. I mean, look, I think AI, has been the conversation over the past 6 to 12 months. It's really changed the industry, and it will continue to change the industry. And I think if you talk to LPs, they want to see GPs really being thoughtful about how to harness this such that, they can create efficiency and really use the brain power to make the right sort of synthesis and judgment calls. And so you are seeing, LPs sort of want to see GPs utilizing it throughout their process. LPs are also using it on their own end. We tell GPs all the time, like, you thought you had to be prepared for a DD session. Now you have to be like doubly prepared. LPs have, sort of all of the quantitative stuff at their fingertips. They're able to deeply research specific companies, sectors, like things like competitive analysis, benchmarking. It's just that much easier to do. And so, we always say to our GPs, like, you have to be 2 steps ahead. You have to not only know the answers, but you have to anticipate the questions proactively address. And actually, your job is to make sure that you're not only addressing it, but that you're actually tying it back to the core story and tenets of who you are.
Fair enough. Alex, what did we not cover today that you wanted to make sure that you shared with the world?
Yeah. One other thing it'll be like an addendum to that other piece. I think the other really interesting thing when it comes to AI and how LPs are sort of how it's maybe changing diligence is, when LPs meet the team, like they don't see any, like there's no need for a human calculator anymore. LPs, to some extent have always done this, but now they're really looking at, is this a team that can genuinely convince founders? Is this a team that thinks well together? Is this a team that can sort of come to, ahead of the curve insights before, all of the AI agents do? Is this a team that, is building apprenticeship into its, every day such that like great investment acumen and judgment is being passed down through the ranks? And so I think that just puts a slightly different lens on how you have to think about DD sessions, how you have to train your team to really knock those out of the park.
So it sounds like even if you have the best technology in the world, nobody's going to write a $20 million check unless you can trust the people, the processes, legacy planning, and the human infrastructure of a firm. I couldn't agree more with you. Well, this has been fun. I appreciate you taking the time, and congrats on the continued success and the new role at Rede. Looking forward to see what you continue to build over the years to come, and we'll see you soon.
Fantastic. Well, thank you so much, Derek. It was a real pleasure.